Hey, my name is Torolf Haugstad and I'm Senior Vice President of Flex LNG and will be the moderator for this webinar. First, we wish you welcome to this webinar. Today's presenter is Øystein Kalleklev, CEO of Flex LNG Management AS, who will talk you through the slide deck distributed, where we will give you an overview of the market and the outlook for the second half of 2020. The webinar will also be followed by a Q&A session where you, as participant, can ask questions on an anonymous basis, but feel free to put your name in the chat in case you prefer this. We will spend about 15 minutes on Q&A, so we'll try to answer as many questions as possible, and we will try to pick the most relevant. So over to you, Øystein.
Thanks, Torolf, and thank you to everyone attending this first Flex LNG webinar. Given COVID-19 travel bans, it's been complicated for us to attend investors' conferences. So we are therefore hosting this webinar, where we can give everyone an update on recent market developments, as well as developments in our company. We are recording this live webinar, so it will also be available on demand on our website, flexlng.com. First, a disclaimer regarding forward-looking statements and completeness of details, and the full disclaimer is available in the presentation. So then let's head to the recent events, slide number 3. The fallout from COVID-19 pandemic has resulted in convergence of global gas at record low levels. Recently, gas both in Europe, Asia, and US have been trading around $2 per million BTU. This is unprecedented low levels, and it implies an oil price based on terminal value of gas of around $11 per barrel, while oil now has bounced back to around $40 per barrel. Historically, gas has been priced at 15 to 30% discount to oil. The discount is currently 70%. Please note that this is the spot price of LNG, while the vast majority of LNG, about 70%, is priced to oil at the 15 to 30% discount as mentioned. The low LNG price have resulted in LNG buyers utilizing their options to cancel US cargoes. In total, we now expect about 130 cargo cancellation in the period April to August, with peak months in terms of cancellations being summer months, June, July, and August. From September, we are expecting cancellations to tail off as heating season starts in October, with substantially higher cargo prices in the futures market. Furthermore, the CONTANGO should also stimulate floating storage. The cancellation option is a unique feature of the US volumes, and which is not something you find in other LNG offtake agreements. We will explain a bit more about this later in the presentation. We also have several ships for delivery over the next couple of months. We generally prefer fixing new buildings ex-yard, as these ships do not have SIRE or inspection certificates, and securing such inspection these days is proving very difficult due to all the movement restrictions. So we are pleased to announce that we have secured employment for the 3 new buildings, Flex Aurora, Flex Resolute, and Flex Amber. We have a combination here of fixed and variable hire contracts, with 2 on fixed rate, while 1 ship will be on variable hire. The earliest redelivery for any of these ships is second quarter next year. There has been a lot of market rumors about our new buildings, and we have actually heard them fixed out several times at various rates, both high rates and low rates. So we rather prefer disclosing the fact that these ships are now not available in the market. However, we will not provide too much details on these contracts as they are short-term in nature. We also have Flex Artemis scheduled for delivery to Gunvor in August, and she will enter long-term charter up to 10 years with a minimum period being 5 years. The hire is here variable as previously disclosed. So all in all, we have a 50-50 mix of variable and fixed hire on these 4 new buildings. We also have 6 ships on the water and 3 new buildings. Of these ships, 1 ship is fixed TC to Endesa, 2 ships are on variable hire, and 3 ships operate in the spot market. So all in all, we have a mixed portfolio of contracts and spot exposure, which ensures an adequate level of firm earnings while keeping exposure to the overall freight market, a market which we expect to start improving about now. Market slide 4 does not flat movement in the spot market since we reported Q1 earnings at the end of May. The market started to firm up in March as China dealt swiftly with the novel coronavirus. This resulted in LNG prices bouncing back 30% to $3.50 per million BTU in March, and spot freight rates for modern going to $1,000 per day with full round-trip economics, which is pretty okay for this time of the year coming out of the winter. The market, however, soared in April as people realized the extent that COVID-19 had gone viral and the economic ramifications. Consequently, rates for modern tonnage dropped to around $40,000 per day and have stayed there for the last 3 months. Furthermore, the market has also moved from two-way economics, i.e. round trip, to one-way economics, i.e. only hire for the laden leg. The swing in balance is more than the 20,000 drop in headline rates. This means that we are operating at unsustainable low levels, where particularly owners of older tonnage are not even able to cover their daily marine OPEX. Fixture activity has, however, been booming with a record high level of fixture activity. However, it's mostly been single voyage charters rather than multi-month or longer-term charters. This short-term focus was caused by big uncertainty about shipping demand, maybe not surprising given cargo cancellation and discharge disruptions resulting in very volatile floating storage levels. Furthermore, that the industry have been spread around at home offices rather than at HQs have resulted in generally less decision-making authority, which have made it easier to opt for single voyage charters rather than doing big decisions right now. So if we look at the gas prices in slide 5, I've already touched upon the product market in the introduction. As you can see from this chart, Asian LNG prices and European gas prices have been plummeting from close to $10 and $8 respectively at the beginning of the year to around the levels at Henry Hub of If we look at the contract prices, which are about 70% of the market, these track oil with a 3 to 6 months lag at the mentioned 50 to 30% discount. Once we get to autumn, these contracts should converge to $4 to $5, depending on whether you are buying expensive or relatively affected LNG. This is cheap and will stimulate demand and coal to gas switching, also particularly in Asia, where importers have substantial contract coverage. Since the super contango in oil during spring is history, with the recent rebound in oil prices, the oil price has flatlined, just higher price for delivery next month. Contract prices for LNG tied to oil price will thus be fairly stable at around $6 to $7 once reconfigured to oil at around $40. This is unless oil prices start moving again, which I wouldn't rule out. Spot prices for the TTF and Asia, the JKM, are on the other hand in steep contango, although admittedly from very low levels. Once the spot prices spread out from Henry Hub prices, it does not make economic sense to cancel cargo, as it's better to take delivery of cargoes and ship them. Not only European gas inventories is approaching tank tops. In the US, inventories are 20% above 5-year average and approaching full levels also by September. Price expectations for Henry Hub are thus muted despite the recent slump in dry gas production following the oil price crash earlier this year. The next US cargoes coming up for cancellation are the September cargoes, with deadline for buyers around 20th of July. Given how spreads are for September and October, we expect cargo cancellations to taper off, which will drive shipping demand and thus also freight rates. So slide 6 is probably the most complicated and busy slide today, so I will try to break it down for you. Volume growth was actually above expectations at the beginning of the year, but started to tail off in May once cargo cancellations made bigger impact. For the first half of 2020, we have export growth of around 12.5 million tons, with a small estimated drop of 1.2 million tons in June compared to 2019. However, please note that the June growth in 2019 was pretty high at 4 million tons. We have seen reports about big import drops in June 2020, but this is also caused by floating storage, which I will return to. In general, we prefer to look at export numbers as these are driving shipping demand. Keep in mind that about 3% of LNG is consumed as boiler fuel, so this takes up about 10 million tons. Also, if a ship is in floating storage, that also drives shipping demand. So the big question is, what will the growth or decline be in the second half compared to 2019? Before answering this, we should note that 60% of the growth in 2019 was delivered in the first half of the year, as illustrated by the gray columns. So achieving growth in second half is less of a hurdle than in the first half. Prior to COVID-19 pandemic, expectations for the year were about 25 million tons versus 2019. However, with the recent cargo cancellation, this is clearly not feasible. In total, US cargo cancellations have wiped out about 9 million tons. We expect some September cancellations, but at substantially lower levels. Hence, if we assume 50 US cancellations, in total we are talking about 10-11 million tons. The only other exporter that have seen a decline in exports is Egypt, which have suspended exports since March after producing about 500,000 tons in 2020 year to date. Egypt is, however, a small producer with annual exports of 3.5 million tons in 2019. If Egypt doesn't resume production later this year, this will be 3 million tons lost. However, cargoes out of Egypt have very short sailing distances to Europe, so it's not. The two largest exporters, Australia and Qatar, are, however, exporting higher volumes in 2020 than in 2019. Hence, we expect export growth to be fairly flat in second half compared to 2019. We expect growth year over year to be around 10 to 11 million tons. Our view is thus very much in line with the LNG outlook published by Energy Aspects on June 30th. A report they title Go Float, as they expect a big build-up in floating storage, which I will discuss later. 10 million ton growth in 2020 is the base case estimate from Fernlist in the June report. However, there are a wide set of expectations in the market, with Toten having the most bearish view with negative growth of 6.7 million tons for the year. This would mean cancellation of around 450 cargoes rather than about 200 cargoes, which we expect. This thus includes the Egyptian cargoes mentioned earlier. Given the fact forward LNG prices incentivize cargo cancellation, we think 10 million ton export growth for 2020 is a reasonable estimate. So if we look a bit more deeper into the books on slide 7, getting data on cancellations are sometimes a bit challenging, with a lot of rumors flying around. A cargo cancelled by a buyer can also be produced by the plant owner and shipped or resold, as the plant owner have then received their tolling fee and usually have the right to put cargo at a marginal cost, typically slightly above Henry Hub, as it takes some energy to cool and clean the natural gas. If the plant owner is also long shipping cost could then also be sunk. So a good indicator to evaluate US LNG production is reviewing feed gas deliveries, US export plants, as all these plants buy gas in the market, predominantly Henry Hub linked gas, except Cove Point and Elba. Cove Point buys gas from the Appalachian hubs, which tend to trade at a fairly big discount to Henry Hub, and this has probably insulated them to a greater extent than the other US plants. We also see less cancellation at Cameron, but the three main off-takers there are also equity partners, so this could influence the decision making. Furthermore, two of these off-takers are Japanese buyers, which typically can sell gas into a heavily regulated market where they can pass on these costs. So if we look at volumes, there have been about half from 8 BCF per day to 4 BCF per day. Expectation with less cargo cancellation is that these volumes will return as illustrated by the graph to the right by Morgan Stanley. Depending on market development, there is of course risk for cancellation next year, which we will also explore on next slide. So slide 8, also a pretty busy slide. This is about the short-run marginal cost of various LNG exporting plants. So why are the US cargoes the ones to be shut down? First of all, it's about a business model where either the plant owner or the cargo buyer source gas from basically the grid, and the plant can be described as a tolling station where buyers have the option of cancelling the cargo as long as they pay the tolling fee, which has historically been from $2.50 to $3. For new plants, we are seeing tolling fees around $2 as efficiency have increased, particularly with regards to modularity, while the big cost element, capital, have become cheaper with an aggressive interest rate cutting by the Fed. Furthermore, buyers of the US cargoes have full destination flexibility. This means they can sell the cargo wherever they want. This sounds obvious in commodity, but historically, there have been a lot of restriction in this in the LNG industry as plant owners want to avoid that its customers are competing with their cargoes. Not explored too often is the short-run marginal cost as mentioned. And on this basis, US plants are at the highest short-run marginal cost level, except for the small FLNG projects. The US liquefaction projects are independent LNG projects and not part of a bigger integrated project, which typically entails liquids in addition to gas, which tend to include cheap associated gas, with several projects de facto having negative feed gas price. Hence, for these integrated projects, you would probably not shut down volumes even if the contracts were tolling models rather than a model, which is the typical contract for the vast majority of LNG projects. This also explains why, despite low LNG prices, the Qataris are going ahead with its expansion project, as it's an integrated oil and gas project with expected FOB price of about $4, the price of around $5. Floating storage, slide 9. The recent years, floating storage have become a repetitive theme. Last year, in spring 2019, we were very confident that we would see a spike in floating storage due to the contango in the LNG, relatively high winter prices in the forward market. We were proven correct as we ended up with around 35 ships in floating during early part of the winter, and the shipping market was entirely sold out in October with spot rates at $150,000 per day for modern tonnage. This year we see a level of floating storage, but it's not driven by contango, but rather diversion and congestion causing delayed discharge due to, of course, the COVID. However, as we said in our Q1 presentation in May, we do expect floating storage to build up due to contango and high onshore inventory levels when we are approaching autumn. That said, the price spreads on product prices are currently not at the level where the market could sustain $150,000 per day for arbitrage of spot cargoes. $150,000 per day could be feasible for contract cargoes in the event of low vessel availability, as these cargoes today have as contractual delivery obligation. As mentioned on last slide, the short-run marginal cost for these integrated projects also tend to be low at less than $2, so there is a lot of possible margin for shipping for such cargoes. That's also why the buyers of contracted LNG tend to put ships on long-term charter to ensure having shipping available and thus securing their margin. The energy aspect LNG outlook report referred to earlier in the presentation conclude similarly with an estimate of potentially up to 50 ships in floating storage this winter, which is higher than last year. So financing, slide 10. When it comes to finance, there is few news except for the fact that we have signed both the $125 million bank loan and 156.4 million sale-leaseback during June. We announced this financing in connection in May, but then subject to final documentation, which is now done. This means we have raised $1.7 billion of debt the last 2 years and $910 million in total for the remaining 7 new buildings. This debt will be available at delivery and cover the $937 million in remaining capex. We also have a rock-solid cash balance end of Q1 at $121 million to cover the $27 million unfunded capex. We have previously guided TCE of close to 50,000 per day in Q1. Given the fact we are currently cash break-even at around $50,000 per day, which will lose $45,000 per day once all ships are delivered, this means cash movement in Q2 is limited, as we have no ships for delivery in Q2 and no new financing drawn or paid. We will, however, report more details on financials when we are presenting Q2 numbers in August. Also worth noting that all our debt is long-term at attractive levels with no maturities prior to second half of 2024, which means we have no refinancing risk for several years to come. So, events. This slide is a repeat of our Investor Day slide in February, just to highlight the 4 main drivers which affect the market heavily in the short term. The obvious factor is the weather. We have had 2 record warm winters in a row, and this have impacted storage level and thus summer prices for gas with adverse effect for shipping. The winter last year reduced gas demand in Europe by about 10 million ton equivalent of LNG. And this is compared to a normal winter in Europe, not even a cold winter like we had in 2018 with the beast from the east. 10 million tons lost demand is more than the current US cargo cancellations. And this is just Europe. Asia is 3/4 of the market, so a cold winter in Japan, China, and South Korea is more favorable for LNG. So weather is definitely a big driver for LNG in the short term. Energy is also about politics, and there's been a trade war going on between US and China. Phase 1 was signed in January, creating some optimism, but COVID-19 happened, and although LNG imports by China from US resumed in March, the volume's been fairly muted compared to the agreement. Another factor is economics in relation to LNG demand. This is more about what kind of shape will the recovery be. Will there be a second wave or multi-wave pandemic affecting sentiment and economic activity? Or are we seeing the light in the tunnel with vaccines and remedies coming soon? And as we are been well aware of recently, there is events, the low probability, high impact events that shape developments for good or bad, with COVID-19 certainly being a bad event. So before summarizing, and while on the COVID topic, we would also like to extend gratitude to our seafarers again, which are running the ships through these challenging times. Crew rotation has been very difficult since the outbreak, and according to economists, there are 250,000 seafarers overdue on their contracts. This is due to travel restriction and made worse by the fact that governments have been able to not been able to agree that seafarers are key or essential workers, like, for example, truck drivers, despite the fact that trucks would be empty unless seafarers ship the goods to the port. In this regard, I'm very we today were able to carry out crew change as planned on Flex Courageous. So these seafarers are able to reunite with their loved ones. With this crew change, we have been able to rotate key crew on all our 6 ships since COVID-19 outbreak. But a lot of work remains. Particularly Filipinos remain close to impossible due to travel restrictions both in Philippines and abroad. So it's time to sort this out. So to summarize very quickly, as I spent some time going through the slides in detail, despite talking fairly quickly. So with recent fixtures, Flex LNG is positioned with a mixed portfolio of fixed variable contract as well as ships in the spot market, a market we think will improve near term as we expect substantial reduction in US cargo cancellation and increase in floating storage. And for floating storage, we have the best ships, as our ships are large ships with low boil-off rates. As mentioned on previous slides, there is a lot of factors outside our control which also affect the market. Near term, winter temperatures and shape of economic recovery are the 2 most important factors which will affect the shipping market in the near term. When making the draft slide, we also included a big donut, which should represent the new buildings of 2020. But then COSCO confirmed 3 new buildings on June 30th. Anyway, the positive side of a weaker market and extremely limited appetite by investors and banks to commit capital to the sector is that new buildings dry up. That said, we do expect to see a lot of forward for some of the big projects sanctioned last year, as well as the mega expansion by Qataris. Lastly, we would like to point out our strong balance sheet and financial position. We have secured the equity we need. We have a substantial cash position and 910 million of financing in place. This puts us in a good position to continue building the company and pursuing a strategy of creating longer-term contracts, as there are about 160 older steam and tri-fuel ships due for redelivery the next 5 years or so. There are still around 200 steam ships in the market, or about 40% of the fleet. So we think this period we will see increased retirement of particularly the small inefficient ships built prior to 2000. Additionally, there will also be shipping opportunities created by the 70 million tons of new projects sanctioned last year. So that concludes our first webinar. Listening, and let's open up for some questions once I have a sip of water. Rolf.
Okay, first question. Taking into consideration the low commodity pricing, I am curious as to what percentage, roughly, of multi-month charter inquiries to Flex are now structured with a floating rate mechanism, as opposite to being based on the standard straight-time charter rate?
Yeah, I think I answered that in the presentation. Actually, we have 6 ships on the water, 1 on fixed TC, 2 on variable, and then, okay, sorry, I just started Siri on my cell phone. So. 1 on fixed TC, 2 on variable TCs, and 3 in the spot market. And then, as we announced today, we have announced, the Gunvor TCP is, of course, well known for Flex Artemis. And then we have 3 ships where we have 1 on variable and 2 on fixed. So it gives us a good balance. We have clean spot exposure on 3 ships. We have then 4 ships tied to the but with protection from utilization, and then 3 ships with fixed hire. So a good balance, I would say.
Okay, no more questions so far.
Yeah. Okay. I guess you get 30 seconds to come up with that question. Otherwise, I think we are adjourned for the day. Okay. Very clear then. I hope you enjoyed the presentation. I wish you a good day, and we will be back in August with our Q2 numbers. Some update both on the markets and of course more details on the financials. Thanks a lot, and thank you to all for hosting the presentation.
Thank you. Bye.